Will investing in the Shriram Life yearly cash plan help you achieve your financial goals in the long run or not? Let us find out the answer to this question through an in-depth analysis in this video. Hi, welcome to holisticinvestment.in, where we help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. Now, before analyzing this policy, let us first understand a few basic details about it. This is a non-linked participating individual savings life insurance plan, and some of the key features of the policy are: there are multiple premium payment modes available where you can pay your premiums yearly, half yearly, quarterly, or even in a monthly basis. And it provides you with an annual assured cash bonus of a minimum of 2% a year, and the cash bonuses are paid from the first Shriram Life yearly cash policy anniversary itself. And you're provided with two options to receive the cash bonus, either through yearly cash or super growth. And the premium paid by you is eligible for tax deductions under Section 80C. And there are benefits like death benefit, survival benefit, and maturity benefit. So in case of death of the policyholder, unfortunately during the policy term, then the nominee will get debt sum assured plus accumulated cash bonus if it was declared, plus terminal bonus if it was declared. This will be given to the nominee or beneficiary, and then the policy will be terminated. So here in this death benefit, the debt sum assured is defined as higher of either the 10 times your annualized premium or 105% of your total premiums received till the date of death. So the death benefit will be at least 105% of the total premiums received till the date of death. So survival benefit here is, suppose if the policyholder chooses the yearly cash option, the annual cash bonus declared will be paid as regular income at the end of every policy year throughout the policy term. And the minimum cash bonus payable is guaranteed at 2% of the sum assured per annum. And this benefit is not available if the policyholder chooses the super growth option. And in terms of maturity benefit, which is in case of survival of the policyholder up to the end of the policy term, provided the policy is still in force, then the basic sum assured plus accumulated cash bonuses if it had any, and terminal bonus if it was declared, will be paid as a maturity benefit to the policyholder. So these are all the benefits. Now let's take a look at the advantages and disadvantages of investing in this policy. So the advantages are, this policy provides you with comprehensive cover which can be further extended using riders, and as the entry age is just 3 years, this policy also financially protects minors. And the plan offers flexibility in terms of premium payments and policy term, and the maximum loan allowable is 80% of your surrender value, and here your cash bonuses can be deferred and allowed to accumulate. So these are some advantages. Disadvantages are, the cash bonus rates may vary from year to year and will affect the cash flow, and the cash bonus might be often utilized for discretionary expenses. So these are some drawbacks that you need to keep in your mind before deciding to invest in this policy. So now we have a basic understanding of this policy, but before investing in any product, understanding the cash flow and calculating the potential returns are two important aspects. So the cash flow pattern under this policy is, either you can receive the survival benefit yearly, or it can be received along with the maturity benefit in case you have chosen the yearly cash plan. So for better understanding, the next step is estimating the internal rate of return. So let us work out the IRR of this policy based on the benefit illustration given in the policy brochure. So here let us assume, for calculation purpose, a 30-year-old male purchases this policy for a sum assured of 10 lakhs, and the policy term is 20 years and premium paying term is 10 years. So the annualized premium is 1,20,030 rupees. He has chosen the super growth option, which is to accumulate the cash bonus. So just for the purpose of example, here the rate of investment returns has been assumed as 4% and 8% per annum, just to indicate worst and best case scenario. These are not guaranteed returns, and they are not indicating that this is the only limit to how high and low this policy can get. This is just to give you an example of how this policy can perform at both ends of the spectrum, because the actual returns will vary depending on the future investment performance of the policy. So at 4% scenario, in the worst case scenario, the final maturity benefit including the accumulated cash bonus is 18.06 lakhs. The IRR calculation for the 4% scenario results in 2.65%. At the 8% scenario, the final maturity benefit including the accumulated cash bonus is 31.18 lakhs. So the IRR calculation for the best case scenario is 6.25%. So both these rates are lower than the inflation rate. So in this example, the super growth option is chosen. That means instead of receiving a yearly cash bonus, here it is deferred and received at the end of the policy term. But if you receive a yearly cash bonus, the IRR will be even lower than the calculated figure. So here, as we have compared this policy and we have seen that this policy is not giving us a desirable outcome because the IRR ranges from between 2 to 6% only. So just to give you a better idea about how other products in the market are performing, we can do a comparative analysis. For that, we are going to explore an alternative strategy where instead of investing in a bundled up insurance policy, like where they couple insurance and investment in one policy itself, we are going to separately invest in insurance and investment in this alternative strategy. So for insurance purpose, we have opted for a pure term policy for the sum assured of 10 lakhs, which would cost us an annual premium of just 5,200 rupees. The policy term is 20 years and a premium paying term is 10 years, similar to the Shriram policy for a fair comparison, but in general it is advisable to have adequate life cover including all your life goals and liabilities. So the life insurance premium is paid out first and then the balance is utilized for investment. So here the balance amount of 1,14,830 rupees is invested in equity instrument called ELSS mutual fund. Why ELSS mutual fund is because even though it's a market linked product, it has proven to give a better risk adjusted returns based on its track record. Because if you take a look at its track record, if you choose to invest in 7 or 10 years for the long term period, like how we invested in the Shriram policy, you can see that it has even outperformed its average benchmark of 12% in certain cases. So the final maturity proceeds from the ELSS funds are subjected to capital gains tax. So the final maturity proceeds from the ELSS fund are subjected to capital gains tax. And if you have any doubts regarding how the ELSS tax is calculated, we do have a small tabular column presented on the screen for your reference, which you can pause and see. So here, as you can see, the pre-tax value is 70.09 lakhs. The post-tax maturity value is 62.92 lakhs. And the IRR for the combination of pure term life insurance plus ELSS investment results in 10.96% on post-tax return. So this is definitely an inflation beating return because investing separately here ensures better returns and liquidity, and the returns in this alternative strategy are higher than the inflation rate. So this empowers you to fulfill your goals in the future, while Shriram policy lacks in terms of returns and liquidity. So what is the final verdict on this policy? This policy offers you survival benefits in the form of a cash bonus. The cash bonus rates are non-guaranteed. So hereafter here you can't rely on this benefit. You can't earmark the cash bonus for any specific expense. This hits your cash flow badly, and high agent commission of this policy also reduces the overall return. So even if you accumulate a cash bonus and receive it at maturity, there is no added benefit, and this policy is the traditional life insurance policy with survival and maturity benefits. Accumulated corpus under this plan is not advisable as the rate of return is lesser than the inflation rate. Clubbing insurance with investment is a major reason for poor returns. If you have an adequate life insurance policy to protect your loved ones and invest separately based on your life goals and analyze your personal risk tolerance before choosing investment products, you can see better outcome in the future.
If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.